I'm Mike Benetello, and I'm joined by a panel of experts, starting with our guest speaker, Francois Fouche. Francois is a co-founder and director at Boundless World, and he spent time at Wharton Econometric Forecasting Associates, a US-based commercial think tank founded by Nobel Prize winner Dr. Lawrence Klein. Francois advises central banks, governments, and industry bodies on a variety of topics involving trade and investment, including evidence-based exports, strategy development. He also works closely with individual firms in multi-industries, advising on company-specific trade strategy. Wearing his academic hat, Francois teaches trade and economics at GIBS and the Northwest University Business School. He's also a frequent speaker and panelist on economic developments in South Africa and across the continent. Welcome, Francois. I'm also joined by fellow colleagues and partners, Kelly Wright, Robyn Berger, Yasmeen, Suliman, and Julia Choate. Before we move on to the macroeconomic analysis, maybe just some house rules. If you are wanting to ask any questions, please make use of the Q&A facility, and we will answer those questions at the end of the session. So without any further ado, I hand over to Francois to provide the economic assessment. Thank you.
Thank you, Mike. Let me share my screen. Mike, can you just confirm if they can see my screen?
Yes, we can, Francois.
Excellent. Thank you, Mike. Let's start at the beginning. Usually, budget speeches are dry lists of numbers. The minister stands up, tells us we are broke, and we move on. But this year's budget has a dramatic narrative arc in it, if you will. Treasury is boldly claiming that we have reached a fiscal turning point. They are declaring an official end to what they call the fiscal wilderness. Now, for years, our country has been stuck in this wilderness. The budget text characterizes this as a toxic mix of a rising debt, low economic growth, and relentless electricity crises. So I think let's put this claim to the test. And is this genuine a turning point, or are we just spinning around in circles? Let's look at some numbers. We have to start with the sheer magnitude of the headline achievement in the budget, and that is the debt stabilization. For the first time since the global financial crisis in 2008, the runaway exponential growth of government debt seems to have stopped in South Africa. If we look at gross loan debt, it seems to me it's stabilizing around the 78% mark of GDP, and of course the projections are that it will decline. However, I think we must remain very grounded in reality here. This plateau is incredibly high. Our debt is at least 3 times higher than what it used to be a decade and a half ago. At present, our debt service costs are sitting north of 430 billion rand for this year. That is almost R500 billion spent just to pay for interest on past mistakes. Stabilizing at this level means that 1 in every 5 rand of revenue goes straight to debt service. So Treasury has successfully stopped the bleeding, I think, but the wound is still very deep. If we look at the mechanical driver behind this debt stabilization, that is the primary surplus, which currently sits at less than 1% of GDP. If we were to translate this sort of accounting term or magic into plain English, government is finally bringing in more revenue than it spends on everything except its interest payments. So think of it like a household that has finally stopped using credit cards to pay for groceries and rent. They are surviving on their salary and only paying down interest on their old debt. So the primary surplus is actively projected to grow beyond 2% in the coming years, proving we are not taking out new debt just to keep the lights on. So I think this brings us to what I call the dividend of discipline, because of better than expected revenue collection, Treasury has delivered a little bit of a plot twist in the budget. The narrative here is very powerful. Treasury has tightened their belts so that we don't have to tighten ours. So Treasury needs to make this tax relief the actual hero in my mind, and, the hero of the fiscal discipline story, rather than just a footnote in the budget. I also think that government has announced full inflation adjustments for personal income tax brackets and medical credits alike. And of course, this prevents the so-called stealth tax hikes, where inflation pushes you into a higher bracket from taking place. This is a psychological and a financial victory that has the potential to eventually put real purchasing power back into the pockets of consumers and businesses. Potential to, it's not guaranteed though. Speaking of purchasing power, I think we must discuss the most significant structural shift in the budget review, and that is the lowering of the inflation target to 3%. National Treasury often treats this as a so-called technical adjustment, but in reality, this is a behavior-changing social contract. So inflation and high inflation is a thief, and it acts as a highly regressive tax that hurts the poor by far the most. Treasury goes on to link the lower 3% inflation target to a 1.3% drop in unemployment, arguing that lower inflation creates the stability needed for small business to actually hire more people. Now, lowering this inflation target essentially lowers the cost of doing business in South Africa. And if by dropping the inflation target to 3%, I think government is attempting to protect the future value of wages and also, more importantly, the basic food basket. Now, internationally, the perception of this fiscal discipline is already paying off. We've received a credit ratings upgrade last year. We are still not back into investment grade territory, and we were removed from the grey list as well. However, I don't think we can ignore the mechanics of how we achieve that 3% inflation target. To force inflation down, especially when facing supply shocks, the Reserve Bank must keep tighter monetary policy for longer. So in the short term, that means higher interest rates. I do think that Treasury needs to humanize this data to sell the long-term gain versus the short-term tightness that we will likely experience. And I think one way to do that is to perhaps show a concrete sort of scenario comparing a 3% inflation world versus a 4.5% inflation world over the next few years, showing that the basic food basket basically costs less in 5 years under the new dispensation versus what we've had up until now. Of course, this creates a fierce debate. Are we prioritizing the price of goods over the ability of businesses to earn capital that they really need to hire more workers? And Treasury is in essence betting that anchoring the inflation expectations at 3% will eventually trigger higher growth in fixed investment as well in the economy. Now, I, for one, certainly hope that this does work because the lower inflation expectations is a really a very, very tall social order to pull off, especially if so many public sector workers have received above inflation wage increases for such a long period of time. If we move on to the engine room of the economy, Operation Vulindlela, if you want proof that structural reforms are working in South Africa just very, very slowly, I think we can look at the energy sector. Load shedding has been suspended since May 2025, though it is difficult to imagine that this is a great achievement. This wasn't an accident. It was the result of clearing very specific regulatory roadblocks to unlock over 23,000 megawatts of private investment in South Africa. But we must also acknowledge that the massive private capital that has been involved, households and businesses have spent billions of their own money on solar panels and batteries in order to keep the lights on. So I think the success proves the reform model is working, and it shows us that when the state sets the rules and steps back, the private sector very effectively fills the gap. Operation Vulindlela is now being used to also bulldoze through other pieces of red tape in our economy. but nothing compares to the total planned infrastructure spending of more than R1 trillion over the next 3 years. The frustration is, of course, that this trillion is like a ghost. Everybody talks about it, but nobody has seen it. It's a very opaque trillion, and also an incredibly slow-moving bulldozer of red tape for the rest of the industries. In logistics, for instance, Transnet has signed a 25-year deal with a private partner. This private participation is helping freight rail getting unstuck. And it's not just in heavy infrastructure reforms, but it's also in tourism, where a special admin fix to streamline visas for Chinese and Indian tour groups processed 40,000 travelers coming into South Africa and created an estimated 3,000 jobs. So nothing to be sneezed at, and I'm sure we can duplicate that for other applications of tourists as well. I do think, however, that despite these victories, I worry we are playing economic whack-a-mole because we fixed electricity, but water is rapidly becoming the new electricity. The budget shows that water reform is only 11% achieved, highlighting a massive implementation gap. The budget mentions establishing a national water crisis committee, which is, in my mind, an admission of a state that is reacting to failure rather than trying to prevent it. Logistics also still faces hurdles. We saw the Durban container terminal, the private sector transaction, delayed by litigation for months, causing some exporters to entirely miss the commodity boom. I think the question that we need to ask is, can our economy afford to wait another 5 years for the new National Water Resources Infrastructure Agency to really sort of find its feet? I think we need a battle plan. I think we need a plan with very specific legal and administrative pathways out of these crises. And we need it yesterday. We can't wait for such a plan any longer. In terms of government efficiency, I know it's an oxymoron, but it's easy to assume the Treasury is slashing budgets left, right, and center. But what we are actually seeing is a drive for financial hygiene, in my mind. This isn't just about cutting bone, it's in fact cutting fat. The National Treasury's TARS initiative, the first round of that initiative, has identified about 12 billion rand in wasteful programs. It's difficult to believe it is only 12 billion. It's not great, but every drop certainly helps. More dramatic is that a public payroll audit has flagged more than 4,000 high-risk ghost workers, or so-called ghost workers. Now, a verification process to weed them out is apparently underway, or so they tell us in the budget. If we combine that with cutting the dead weight of about 7,000 older public servants that are stepping down from early retirement, it is clear that the narrative has shifted in the Treasury. Shifted from how much we spend to how well we in fact spend. In my mind, all government programs should be subject to value that actually gets delivered, not just whether the expenditure was recorded or not. This, unfortunately, is still not a focus point for Treasury. For those who argue that that this is a very ruthless austerity budget, the data tells a slightly different story. I think despite the fiscal consolidation and a staggering 60% of all non-interest spending still goes directly to the social wage in South Africa. Government is currently carrying a massive social responsibility, actively supporting 26 million social grant beneficiaries and 13 million school children. However, the reality of fiscal consolidation means that consolidated government expenditure is growing at an average rate of less than 4%. And with inflation hovering around 4.5%, in real terms, spending on health, education, and policing is in fact shrinking. And this is not a bad thing, since the fiscal multiplier is less than 1 in any case. And even Treasury admitted this in the budget review 2 years ago. So government can in fact afford to spend much less, and the economy in terms of GDP measurement won't feel much of it. What this budget does, I think it balances strict financial hygiene with the reality of a country that requires immense social protection just to maintain the stability. There is, however, what I would refer to as a so-called narrative dissonance in the budget. And it is in the following way. The budget seems to treat fiscal health rather, and economic growth as parallel tracks rather than cause and effect. I'm going to say that again. It treats fiscal health and economic growth as a parallel track rather than a cause and effect. Treasury seems to be celebrating an accounting achievement here, but out in the real world, the economy is still suffocating. Real GDP growth is dismal. Our labor absorption rate is still only at 40%. What Treasury has done is Treasury has successfully stabilized the patient, but the patient is still in a coma at the moment. If this doesn't translate into massive job creation, I think the social burden eventually will overwhelm our fiscal progress that we've made. The biggest drag on our growth is, in fact, local government. Yesterday's budget openly admitted that 162 municipalities, or about 63% of them, are in financial distress, and that the current approach to fixing them seems to have reached its limit. Treasury is trying to use a debt relief strategy as a leverage, the so-called carrot and a stick approach, to force municipalities to fix their billing systems and to reinvest in their own infrastructure. Now, you can have pristine national budgets, but if the local municipality rather cannot keep the water treatment plant from running, the citizens and the business owners will experience state failure at the local level. We cannot treat the macroeconomic growth and the municipal collapse as two separate chapters in terms of the budget. We need, in fact, a so-called scenario C, in my mind, in the budget that specifically models, the macroeconomic growth impact if about half of all the distressed municipalities successfully adopt, this new utility model that they talk about in the budget. I'm very skeptical of this approach, to be honest with you, because I live in Johannesburg. And what we've experienced in terms of service delivery is dreadful, to say the least. To ensure we never return to the fiscal wilderness, Treasury, I think, has failed to provide very necessary detail around the so-called fiscal anchor, which was also mentioned but not discussed in detail last year. Essentially, this could be a law requiring new administrations to table a fiscal plan to force, sort of financial discipline. The problem is Treasury, in my mind, should preemptively outline, the proposed mechanisms of the so-called enforcement, whether it's a hard cap on debt to GDP ratio of 60%, whatever the number is, to prove that they are in fact willing to tie their own hands rather than just delivering a plan to have a plan. We have too many of those in any case already. And I think we must also ask the hard question when it comes to this potential fiscal anchor, and that is, does this protect the country's future from reckless politicians, or does it act as a so-called golden handcuff that legally may restrict future leaders from responding to the next massive unforeseen global crisis? So I think, Mike, let me wrap up by asking, is this really a turning point as it is articulated in the budget? I think the answer is probably yes, but with a massive asterisk. It is a success story of a little bit of discipline. The ship has been steadied, the leak is plugged, and the engine of private sector reform is humming in the background. It's not revving high, it's just humming, it's idling. However, I think another structural worry remains, and that is our current account deficit, which is expected to widen again in the coming years. Why? Well, because we lack local manufacturing and we are deindustrializing. Even slight economic growth sucks in investment imports, meaning we haven't fixed our internal production and productivity basis as yet. We have balanced the books, but we haven't yet balanced society. The heavy lifting to turn this fiscal pause into a true pivot towards prosperity, I think, is just beginning. Will history view this as a pause or a pivot? We will know for sure with next year's budget. And I think until then, Mike, thank you for your time.
Thank you, Francois. Always very insightful. Thank you very much for that presentation and your views. If there are any questions, just a reminder, please to raise them on the Q&A, and Francois will address those questions at the end of the session. If we move on to the tax proposals, if we move on to the tax proposals, and maybe starting off with just an interesting slide to show where the revenues would come from, and you would see, as is the case with previous years, the balance of the tax that's to be collected is personal income tax. So individuals paying tax still bearing the burden of the fiscus, and then interestingly followed by VAT and then corporate income tax. So those seem to be the three major pillars of tax and major collections. If we move on to the impact of the tax proposals, I think there was general consensus and happiness amongst individuals in South Africa in the sense that thresholds and rebates and duties, as was not the case in previous years, was adjusted for inflation so as to avoid the negative impact of bracket creep. The gross revenue estimates for 25 and 26 were revised upward by 21.3 billion from the 2025 budget estimate, despite lower than expected nominal GDP. If we move on to revenue trends, the gross tax revenue estimate for 24-25 is estimated at 1.85 trillion, which is 16.7 billion below the 2024 budget. But there was a higher than expected net VAT, corporate income tax and dividends tax collection, and that improved the year's outlook. And I think a lot of that credit was given to commodity prices, specifically gold and platinum. If we look at fiscal policy, the use of data and AI has become critical for the future development of economies worldwide, and no different in South Africa. As such, data infrastructure should be considered as critical as electricity, ports, and transport networks. The Treasury has confirmed its commitment to assisting data centers and related infrastructure to expand these investments in South Africa and solidify its role as a regional hub for these technologies, which is good for South Africa. In terms of revenue trends, just looking at some of the trends that we've picked up in the budget review, the gross tax revenue collections are expected to increase by 6% in 26-27, 5.7% in 27-28, and 5.7% in 28-29, growing from 2.01 trillion in 25-26 to 2.38 trillion in 28-29. The tax to GDP ratio is expected to reach 26.2% by 28-29 as economic growth improves. Corporate profitability, as I mentioned, increased steadily during 2025, and that's not across all sectors. It's principally through platinum and gold prices, commodity prices, that is strengthened. And I guess for as long as that happens, this policy will remain stable. Personal income tax collections are projected to fall short of 25 budget estimates, reflecting subdued private sector wage growth. Net VAT collections were revised upward, thanks to household consumption expenditure, which benefited domestic VAT collections, and lower VAT refunds. There was also an offset by weaker import VAT due to lower than expected nominal import growth. Then fuel levy collections recovered following a sharp drop in demand in the previous year, reflecting reduced diesel usage as a result of improved electricity supply. Then lastly, tax policy. So what does the future hold? The 25 budget and 25 medium-term budget estimated that SARS would collect between 20 billion and 50 billion additional tax revenue by increasing collection of tax debt from 95 billion to at least 120 billion in 25-26. SARS and National Treasury implemented monthly reporting on debt collections to enhance transparency and track progress. We certainly have seen SARS very active in the market on that. Total outstanding debt stood at 646 billion on 31 January 2026, of which 518.2 billion is said to be undisputed. By that date, SARS had collected 79.4 billion, falling 15 billion short of the target for the period, due in part to delayed onboarding of additional collection personnel. a rise in disputed debts, and increase in deferred payment arrangements. So, very busy space in the tax market. Recent action by SARS, including enhancing collaboration with banks and hiring additional legal professionals to pursue civil judgments, are expected to increase collections, but it's unlikely that targets will be met. Okay. Then I think we're moving on to the main business tax proposals. I'm going to hand over to my colleague, Kelly Wright, to deal with the business tax. Thank you, Kelly.
Thanks, Mike. Very little this year in the budget from a business tax perspective. The most interesting and most important amendment is that SARS has withdrawn the proposed 23N alignment with 23M. So in 2024, there was a proposal that 23N interest deductions would also be capped at 30%. This sets all sort of tax advisors into a bit of an uproar, and there was a lot of comments that were submitted as to why this was completely inappropriate, because the types of situations to which 23N applies is very different to 23M. We were very proud to collaborate with SAVCA on submissions to Treasury as to why this isn't appropriate in the current climate, and those have now been confirmed that amendment has been withdrawn. So from a business tax perspective, that is definitely the most important amendment. Everything else is a little bit boring. So there's a mining rehabilitation fund regime, which currently applies to mines. So there's tax deductible contributions, and any growth in those funds is completely tax exempt. And the budget notes that because nuclear energy facilities play a similar role and are also subject to very strict legislative requirements, that regime should be expanded to apply not only to mining environments, but also to nuclear energy facilities. The next amendment is regarding collective investment schemes. So there's been discussion on this for a couple of years. Treasury has now noted that a response document will be published, which will collate the comments that have been received from industry. The proposed recommendations include that all investment returns generated by regular CISs and retail hedge funds will be taxed as capital. That is to encourage savings and to provide industry with certainty about the tax treatment of CISs. However, qualifying hedge funds will be excluded from this tax regime, and an alternative will be proposed. To clarify, qualifying hedge funds are those which are not open to the general public for investment. You have minimal investment criteria, and you have to invest a minimum of 1 million rand. Then very high level guidance was provided regarding the proposed national online gambling tax. So proposal of 20% tax for all online gambling providers was put forward. A draft discussion document was published in November last year. It's open for comment. Comment closes tomorrow. Following that, a workshop will be held, and the proposal is that draft legislation resulting from commentary and workshop will be published later in 2026. A small cleanup amendment was also included regarding short-term insurers. So in 2023, amendments to Section 28 were brought into force to reflect the introduction of IFRS 17. One of the subsections was overlooked, and so there is a proposal to align Section 28 sub 3BA, and that is just to align the tax treatment of insurance liabilities that are transferred between short-term insurers to bring it in line with IFRS 17. A little bit of commentary on incentives in the special economic zones. And this is basically to sort of transfer pricing amongst special economic zones. So currently, certain qualifying companies are disqualified if more than 1/5 of expenditure or gross income arises from transactions with connected firms outside of the zone. So instead of being taxed at the reduced rate of 15%, they would then be disqualified and taxed at the normal corporate tax rate of 27%. However, Treasury has recognized that some of these rules may be too prescriptive and may work against potential investors wanting to use the zones to strengthen supply chains. So government is going to assess whether companies are buying or selling products to connected parties outside of these special economic zones at market-related prices, and ensure that there's no profit shifting taking place to take advantage of the lower 15% rate. There's also been further review of the urban development zone tax incentive. Government is exploring the incentive to target better support for affordable housing development in areas close to jobs, public transport, and essential services. It is expecting to propose real firmer support in the 2027 budget after engaging with stakeholders. And that's it. Thanks, Mike.
Thank you, Kelly. We deal with income tax administration. Ask Dr. Julia Choate to please talk through that. Thank you.
Thanks, Mike. Yeah, not a lot really to discuss from a tax administration perspective. SARS have been quite gentle with us this year, and a lot of the amendments are just to correct sort of ongoing systemic issues. The first and probably most important one is, as I'm sure many people will be aware, following the Medtronic International Trading Constitutional Court judgment, it was confirmed that anybody who applies for and is granted voluntary disclosure relief, so VDP application to SARS, cannot separately apply for or request the remission of interest on that capital amount that is the subject of the voluntary disclosure relief. But what the court did say was there needs to be separate, a separate legislative basis permitting the remission of interest specifically in the context of voluntary disclosure applications. And that is what SARS are now proposing together with Treasury to bring into the legislation so that a successful applicant for voluntary disclosure relief is able to also apply for the remission of interest. This will, of course, remain discretionary, and it remains to be seen whether this has any real impact on providing relief on the total amount payable under VDP applications, but it is certainly a move in the right direction to recognize a more fair application and administration of that voluntary disclosure system. Another welcome amendment is really just a system correction. So Section 256 of the Tax Administration Act is the section that allows SARS to provide tax compliance status and govern tax compliance status. And obviously where one has a dispute with SARS and there is an outstanding amount, if that outstanding amount is subject to suspension of payment, it is not regarded as a debt that causes a taxpayer to become non-compliant on SARS's system. We've had a bit of a mismatch between that concept and similarly the concept that if you've applied for remittance of penalties, that outstanding penalty amount should reflect as suspended. And what would then happen in practice was you've got a disputed amount with SARS, you apply for suspension of payment, you apply for remittance of penalties, you show as non-compliant on the system because while you have a de facto suspension for the capital disputed amount, the penalty suspension is not pulling through under the request for remission. So SARS are now going to ensure that these provisions are aligned so that if one has requested remittance of penalties, that is not going to result in the taxpayer reflecting as non-compliant while that dispute and request for remittance process is ongoing. Then on the provisional tax underestimation penalty side of things, the proposal is that taxpayers seeking to place reliance on the estimated amount need to first actually pay their estimate before it is possible to rely on that amount, and particularly in the scenario where you don't pay, and the 1 million rand cap for historical assessments is going to be increased to 1.8 million, and that is for years of assessment commencing on or after the 1st of March 2026. It's an important thing to be aware of if one is planning on accessing that relief, that there are now certain requirements that have to be met before you can do so. And finally, fully and partially exempt entities, corporate entities, it's proposed that certain of these are going to be excluded from classification as provisional taxpayers, just to reduce the administrative compliance burden both on taxpayers and on SARS. And that is it from the tax administration side.
Thank you, Julia. Now, Robyn Berger, if you could talk through the international and exchange control, please. Thank you.
Thanks, Mike, and good morning to all the listeners and everybody who's dialed in. Thank you for your time. Again, on the international tax front, very few amendments. The most notable one being that we will entrench into our law the latest developments around the global minimum tax. The Global Minimum Tax Act and the Administrative Tax Act were introduced in 2024. They basically bring South Africa in line with the initiatives by the OECD to ensure a minimum tax rate in countries and to basically stop the race to the bottom so that revenue authorities can continue to collect taxes. The date for implementation, registration notification has already been moved from December 2025 to the 16th of March 2026. And now the latest announcement is that the relaxations that were recently introduced in what was called the side-by-side package, which was released by the OECD in January, will also become part of our law. In terms of the side-by-side package, there's a few key elements to it, the one being simplification in order to comply, because these laws are really, really complex and difficult for multinationals to adhere to. There will be enhanced substance-based tax incentive safe harbors so that predominantly developing countries that offer these types of tax incentives aren't negatively impacted. There will be evidence-based stock take process. In 2029, we'll see a review of how it's going, whether it's actually working and that it's not favoring some over others or being biased against others. And the other thing that's really key is that the domestic minimum top-up tax will be the most important aspect. In other words, the home country where the operations are taking place will always have first right to tax. The other minor amendment that's coming in is just to align the controlled foreign company rules with regards to the domestic treasury management rules, because currently under the controlled foreign company rules, when you have calculated your net income of your CFC, you then translate that to Rand at the average exchange rate for the year. But for the domestic treasury management company, you first calculate that in the functional currency that you're using, and then you translate it to Rand. So we have this mismatch because you have a ZAR amount coming through from the CFC provisions. So they intend to just align the two, whereby you won't have to first translate your CFC inclusion before you've translated your domestic management company or domestic treasury management company income. Moving on now to far more interesting reforms and really exciting things, and that's really in the exchange control space. And anyone who works in tax will know that we can't be doing tax advisory or tax administration without fully understanding the exchange control side of things. And the two kind of go hand in hand. And so while we have still yet to see this massive dramatic reform of these rules, we very much so welcome the latest relaxations that were announced in yesterday's budget. The first thing I want to highlight is the statement by Reserve Bank to say that they will be working with SARS and the Financial Intelligence Center to enhance supervisory oversight to ensure anti-money laundering, countering the financing of terrorism and tax compliance. I think that there's certainly in practice become a kind of haze around what is the true purpose of exchange controls these days. Is it to detect fraud? Is it to detect money laundering? Is it to manage the tax base? Or is it really to protect the currency and the capital base of the country? These things certainly seem to be overlapping. And I think one of the statements that seems to really be missing from this first bullet is that I definitely foresee this is going to impact our banks predominantly and placing greater onus on them in terms of compliance. And we are already seeing this in the market, following a recent court case where, the banks are now being asked to almost audit and police tax before they allow funds to be remitted from this country. So I think this is going to be a very interesting space, because I think the onus on banks may just be a little too much. And the other thing they've noted is that they will amend the definition of capital under the exchange control regulations so that it expressly includes crypto assets. And the difficulty here is that there's currently court matters pending where SARB is arguing that it is already encompassed in that definition. And of course, the courts have held otherwise, although this is not a settled matter. Certainly, as far as I'm aware, I believe it's on appeal. Then very exciting element we see again is that they want to introduce a regime that will allow South African fund managers free ability to manage portfolios of foreign assets and to trade foreign currency denominated instruments. I think this is a great initiative. I have personally actually seen a paper on this, and so I think it's very welcome. What I would also like to see, hopefully, is some corresponding tax measures to safeguard these assets and make sure that they don't become unfriendly in terms of the tax treatment of these portfolios. The next point, this is really, really huge. And, you know, we've been lobbying for this change for some time now. And again, really, really welcome, because there was a disconnect between what the Reserve Bank policy was, the exchange control policy was in terms of inbound loans, and the transfer pricing legislation. Many of the inbound loans tend to be mezzanine funding. Mezzanine funding tends to attract higher rates of interest, but there were caps placed on this, and typically it was not possible to comply. This placed international groups in a difficult position from a transfer pricing perspective in the lender jurisdiction, often having to make adjustments without corresponding cash flow. So with this relaxation, it's really great to see that you'll now be able to be fully compliant on both sides of the border from an exchange control perspective. Just bearing in mind, of course, that we have many rules relating to interest deductibility, classification of instruments and hybrid debt. So you really do need to look at this very carefully, but I would suggest that groups that have cross-border loans go back, relook at these, rethink these, and say, you know, do I need to go back for new approvals? The single discretionary allowance, previously known as the old travel allowance, has finally been increased from 1 million to 2 million per calendar year, which is also a welcome change. The limit for credit card payments has been doubled from 50,000 to 100,000. Just to caution that you should not be splitting single transactions to fall within these limits, because they will pick this up. This is heavily monitored. Anyone who's been using their offshore allowance and has accidentally gone over, or has had credit card spend and accidentally gone over, will have encountered the wrath of the regulator here. We've had to deal with a few of these where individuals have been asked to explain why they have exceeded these limits. One or two other limit increases, which you can read on the screen. Another one that I think is really worth highlighting, though, is just the last bullet, and that is that the time lag for residents entering into cross-border merchanting transactions, can't get that word right, and will now be aligned to 4 months, irrespective of the jurisdiction of the foreign payer. So currently, if you are supplying across the African continent, you have a 60-day period, and if it's non-African countries, 30-day period. So they're aligning all of that and giving you up to 4 months to remit those proceeds. So that's also a really great welcome change, although we do see still some difficulty with remittance of proceeds in certain countries, from certain export countries, where you know, foreign currency is simply not available, or the exchange control rules simply don't allow for it in those countries. And that brings to an end my section. Thanks, Mike.
Thank you, Robyn. Now to Yasmeen Suliman for the other taxes, personal, indirect, and other proposals. Thanks, Yasmeen.
Thank you, Mike, and good morning, everyone. I think I've got the busiest section, a lot of changes on the personal tax front and with regard to indirect taxes and so on. Before I get into the details, a few things that I just want to highlight to everyone. First is that if my voice breaks up during the middle of the presentation, I'm sorry about that. I've got a bit of a cold, so do forgive me if the volume drops at some point. The second point is that I did prepare my slides myself without artificial intelligence. Real intelligence was used. If there are any errors, artificial intelligence crept in, and it's the AI's fault, not mine. Speaking of AI, before I get into the detail, I came across quite an interesting post on LinkedIn a few days ago about the use of AI by revenue authorities. And it's quite, I think, relevant, because SARS is using technology a lot more these days than it used to. And we can see a lot more intelligent queries coming through. The particular scenario on the LinkedIn post was related to the Indian Revenue Authority and how it caught out a taxpayer that had manufactured invoices. And essentially, the taxpayer had been asked to prove certain expenses incurred on the improvement of a property, and the invoices related to the period, I think 2001 to 2005. The taxpayer had manufactured these invoices. And of course, most taxpayers think, well, going that far back, how will SARS know? How will the Revenue Authority be able to prove it? In any event, what the Revenue Authority did was it took those invoices, put it into an AI tool, and the AI tool identified that the font on those invoices were actually not available during that period. So just because the font that was used was Calibri, and it was only introduced in 2007, they were able to prove that those invoices were manufactured. So something to be aware of. Interesting story from elsewhere in the world, but something to be mindful of in South Africa as well. Then moving on to the nuts and bolts of the presentation, a welcome change that came through this year was related to personal income tax adjustments. We haven't seen that in the last 2 years, and it was a welcome change for for inflation. One of my colleagues, Anidia, did point out that the inflationary adjustment is only for the current year and did not make up for the previous 2 years that we missed out, but still a welcome change for most individuals. I'm not going to go through these tables in detail, but just to highlight the tax thresholds. Move on, Robyn. Right. The tax thresholds for a person who's under 65 has now moved to 99,000 Rand a year. For a person that's over 75, 171,300 can be earned tax-free. The rebates have all been aligned or increased by inflation. But some interesting statistics just to point out, and I think this points to stats moving the right direction. If you look at the 2025-2026 column, you'll see that there were 7.9 million individuals to pay 811 billion rands in income tax. That was last year's projection. And it's still, a small portion or segment of actual, people that are actually registered for taxes in South Africa. But what you can see is a positive trend where more individuals are starting to pay tax. So in the current year, the expectation is that 8.3 million individuals will pay the 844 billion worth of personal income tax. So more and more people are falling into the tax net. A positive for those of us that are caught in the tax net permanently, the burden at least is being shared amongst a wider range of people. What is quite concerning is the fact that we are quite dependent on a very narrow band of taxpayers. 268,000 individuals, which comprise 1.9% of those that have been registered for tax, pay 33.5% of all personal taxes. Those are typically, the people that earn more than 1.5 million Rand a year, and those people are also quite mobile. We've seen quite a few financial immigrations over the last few years. We personally helped quite a few people exiting the tax system. So, these people are also quite mobile. And the fact that we are dependent on a very narrow base of taxpayers, I think is a bit of a risk for the country as a whole. But overall, it's moving in the right direction in terms of spreading the burden a bit more. Moving on to the next one, some positive changes. So certain tax thresholds and limits have been relaxed. For small businesses, there is an exclusion or an exemption for the disposal of a small business. The current amount in terms of the value of the business, if the value of the business is under 10 million Rand or less, then an exclusion can apply of up to 1.8 million of your capital gain. These thresholds have now been increased. The value of the business has moved to 15 million Rand, and the capital gain that can be disregarded is 2.7 million Rand, which is positive for small business owners that are wanting to then dispose of their business. In all my years of practice, I've only had to apply this provision once, which suggests that actually there's not too many small businesses, that I have come across in my own portfolio. Then for those of you that are involved in estate planning or actively thinking of your own estates, something to be aware of on death. The exclusion on death has moved from 300,000 to 440,000 Rand. The primary residence exclusion has moved from 2 million to 3 million Rand, which is a welcome change. So those individuals that are selling their primary residences, far more will be able to to use, to have a tax-free amount in there. Although I have to say, with a lot of us that have actually added to our premises, we're probably facing capital losses rather than capital gains at the moment. Then annual exclusion. So every year, if you have a capital gain or loss, the first 40,000 Rand of the capital gain or loss is excluded. That 40,000 Rand has moved to 50,000 Rand. So if you have a capital gain in a year, the first 50,000 Rand will be excluded and not taxed. Conversely, losses, this applies to losses as well. If you do have a capital loss, the first 50,000 of that loss will be excluded as well. From a savings and retirement point of view, the tax-free annual limit has moved from 36,000 to 46,000 Rand, but there hasn't been an increase in the overall limit. I think the overall limit is around 500,000. That hasn't changed. So what this means is that if you keep contributing at the maximum limit of the tax-free amount every year, you'll reach your 500,000 Rand limit sooner rather than later. I think when that time frame comes through, where that 500,000 is likely to be on the horizon, I think Treasury will look at whether they're going to increase it, but I don't think that is at hand as yet. With regard to retirement fund contributions, a welcome change. Currently, the deduction for retirement fund contributions is limited to 350,000 Rand. That limit has now been moved to 430,000. So, a lot more emphasis on saving more towards retirement. All these amendments are effective from the 1st of March, 2026. Then with regard to medical scheme credits, I think the good news is they've kept them on. I remember a few years ago, they did talk about, because of the advent of NHI, medical scheme credits were going to be removed completely. So good news is that firstly, they've been retained. And secondly, first time in 2 years, have been adjusted for inflation. So the credits will increase to 376 Rand for the first 2 members and 254 Rand for additional members. A welcome change, but probably not quite in line with the increase in medical aid contributions. Then there are certain statutory medical schemes which face regulatory constraints that remove them from the authority of the Council for Medical Schemes. And consequently, members of those schemes cannot claim medical scheme credits or contributions. What the proposal now is to extend the credit to those schemes, provided that those schemes offer benefits and adhere to governance and solvency requirements that are at least equivalent to those prescribed under the Medical Schemes Act. So good news for those individuals that belong to these schemes but simply cannot claim medical scheme credits at the moment. This should be available going forward. Next slide. Then with regard to employment, where bursaries are provided to employees' relatives, the remuneration threshold has increased to 900,000. It was previously, well, it is currently 600,000. The tax-free bursary amounts have also increased. So remember, the tax-free bursary amount depends on the level of education as well as whether the learner is disabled or not. So that's a welcome change for employers that do provide funding to the employees' relatives to study further. Then with regard to other fringe benefits, some changes that are long overdue. The remuneration proxy cap for employee loans for immovable property will increase to 360,000 Rand, and that was previously 240,000 Rand, while the market value cap will increase to 650,000 Rand. So in other words, employers can provide employees that earn less than 360,000 Rand per annum, interest-free, without fringe benefit, to buy a house that is worth less than 650,000 Rand. And I think that these increases make sense given the increase in remuneration that we've seen due to inflation over the years, plus the value of properties these days. Then the maximum remuneration exemption for employees dying in fulfillment of duties will increase to 800,000 Rand. I suppose this will be like for compensation for dying on the premises or so. But obviously is a welcome change to the families that are left behind. And then with regard to awards for bravery and long service, these tax-free amounts will increase to 16,000 Rand. It was previously 5,000 Rand. And if I remember correctly, that 5,000 Rand limit was there when I was studying. And maybe I shouldn't tell you how long ago I did study. It was roughly 3 decades ago. Let's move on. I'm not going to spend a lot of time on this slide. It just sets out the various thresholds for bursaries and the remuneration changes that I just spoke about. So I'm not going to spend too much of time on this. But the next one is an interesting one. This regards spousal rollover relief. So currently we do have relief in the Income Tax Act in Section 9HB, which provides for rollover relief for the transfer of assets between spouses. Right, I'm back again. Next slide, right. So at present, if a husband transfers assets to his wife, or the wife transfers assets to her husband, there's a relief from capital gains tax on the transfer of those assets. However, what is missing is if the asset that's being transferred is an allowance asset, for example, it forms part of a business. For example, a depreciable asset that's used in a business and it's transferred from the husband to the wife or vice versa. Currently, the recoupment component of rollover is not provided for in Section 9HB. I deal with this provision quite a lot because I do advise quite a few clients on estate planning, and haven't seen too many instances of allowance assets being transferred between spouses. But I suppose it's not beyond the realm of possibility if those are business-related assets. Now, the amendment, which is a welcome one that will come through, is to allow for rollover relief for the recoupment component as well. So if an allowance asset is being transferred from a husband to a wife, the husband won't have to recoup any of the allowances previously claimed and pay tax on that. And essentially, the spouse will step into the shoes of the transferor spouse. And if the asset was finally disposed of, will then have to account for the recoupment in that person's hands. So welcome change, and I think it aligns the CGT to the income tax very well. Moving on to the next one. Moving on to donations tax, some changes to the exemptions effective on the 1st of March 2026 as well. So donations made by entities, the threshold, the tax-free threshold has moved from 10,000 to 20,000 Rand. And for donations made by individuals, the threshold has moved from 100,000 to 150,000. So that, the last time this was amended was in 2007, so definitely a welcome change. And remember, the donations made by individuals, that 100,000, we currently use it not only for actual donations, but also for Section 7C donations tax as well. So a welcome change. It, I think, will alleviate the burden on quite a few taxpayers, especially where they're subject to 7C on loans made to trusts and companies owned by trusts. Then a change, which is not in favor of taxpayers, but is quite an interesting one nonetheless, is related to the interspousal donation. So, in the donations tax legislation in the Income Tax Act, there is an exemption for donations tax between spouses. So if a husband donates to his wife or vice versa, there's no donations tax on that particular transaction. Obviously, there have been some very clever advisors, and unfortunately, this is not a loophole that I have my name attached to. They've come up with a scheme where if spouses are going to be breaking tax residency, they stagger the tax residencies. For example, the wife breaks tax residency first, the husband donates his assets to his wife, and then at the point he breaks tax residency, he doesn't have any assets on his name on which he has to pay exit CGT. And he doesn't pay any donations tax on the interspousal donation either, right? And obviously, because the first spouse has already left the country, she's not going to be subject to any exit CGT on those assets either. So quite a clever scheme. I wonder who came up with it. Unfortunately, it wasn't me, but this is going to be shut down. So the interspousal donation will only apply if the donee spouse is resident in South Africa. And I think that makes sense because it allows for parity. Next slide, please. Then on trusts and wealth taxes, largely unchanged. Trust tax rates remain the same. CGT rates remain the same. Estate duty, donations tax, and STT all remain the same. So as is. Moving on to the next one. Withholding tax rates for dividends, royalties, and interest paid to non-residents also all remain unchanged. Then one of the big changes that's come through related to that, there's been a lot of lobbying. I'm sure you must have seen in the media of the last 2 months. There's been a lot of lobbying about increasing the VAT threshold to a higher amount than R1 million, because the feeling was that R1 million was actually too small. And I agree with that because, you know, R1 million, it really works out to about 89,000 Rand in turnover a month. And if you break it out into weeks, that's at less than 20 what's about 20 odd thousand Rand a week. You know, it's very easy for a small business to be over the VAT threshold. So the welcome change is that has moved from R1 million to 2.3 million. The 2.3 million struck me as a very odd number. You know, I thought, well, 2.3 million over 12 months, why didn't they just move it to 2.4 million? You know, 200,000 a month, it's a nice, clean, even number and so on. So we put this question into Google Gemini today, and Google Gemini tells us that the reason it moved to 2.3 million was because of inflation. R1 million in 2008 is worth 2.3 million Rand now. So, so that's why it's 2.3 million. With regard to the voluntary registration threshold, this has increased to 120,000 Rand, which sits better in my mind because that's 10,000 Rand a month, roughly. Previously, this limit was 50,000 Rand. These changes are going to be effective from the 1st of April, 2026. The one thing I can see that's going to be a problem with the increase in these thresholds is that where we have registrations currently, where it's quite clear that the vendor is going to be making taxable supplies and it's actually going to be quite a large vendor in time, we often have a problem with getting the VAT registration upfront because SARS is very insistent on seeing that the R1 million limit is going to be breached in 12 months. And when you have projects that are like sort of have long lead times, you may not necessarily be able to prove that amount. I see now with these thresholds increasing, we're going to see a lot more scrutiny of the turnover, you know, estimations at the time the registration happens, and a lot more diligence around that as to whether someone needs to be on the register. To my mind, stopping taxpayers from registering for VAT and coming onto the register does not make any sense. Rather, let them get onto the register. Just don't give them any refunds. You know, make it easy for us to be able to, you know, pay the tax to SARS. But obviously, this has fallen on deaf ears. So anyway, that's my bugbear for today. Then a good change regarding the timing of VAT returns between e-filers and non-e-filers. So currently, you know, there's a difference if you are e-filing versus non-e-filing as to which date the date by which the return and the payment needs to be submitted to SARS. So because e-filing has seen a huge uptake, and I don't think there's too many taxpayers that now do manual returns, there's now been the proposal to simplify submission dates so that going forward, VAT returns must be submitted and payments must be made by the last business day of the month, which I think makes sense. It doesn't make sense to have a submission date of the 25th, but payment by the end of the month. Now everything just happens on the same day. It's aligned. It's easy for taxpayers to follow. So this is a welcome change. Moving on to the next slide. So other proposals, and quite a big one for second-hand goods. So for those taxpayers that claim notional input tax on second-hand goods, you know, we already have quite onerous documentary requirements. We see it a lot in the recycling industry, in the second-hand car market, you know, but I suppose second-hand goods lends itself to a lot of, you know, the propensity for fraud as well, because it's a notional input tax. SARS is going to definitely be losing out by giving the, you know, the input tax credit to the vendor and not being able to claim any input, you know, output tax on the other side. The proposal is to tighten up on the documentary requirements for second-hand goods. So firstly, there is there's an act apparently called the Second-Hand Goods Act, and there's certain documentary requirements that are imposed by that act. So the proposal is to make sure that the documentary rules for second-hand goods in the VAT Act align with the Second-Hand Goods Act as well. So we can expect a higher level of documentation required in order to justify a notional input tax. The second change that it's not in favor of taxpayers as well is regarding the time period in which you know, the notional input tax can be claimed. And I think what SARS has seen here has been a lot of, I think, you know, timing issues with the claiming of the notional input tax. And essentially the change that's going to come through is that the taxpayer is going to be restricted to claiming that notional input tax in the period where the supply actually happened. You cannot do it in a later period. Right? And this is obviously subject to the 5-year prescription rule. So what taxpayers will really need to do is actually a request for a reduced assessment then in order to claim that notional input tax. They wouldn't be able to put it into the next period if they missed it out in the period the supply actually happened. Then with regard to the third change regarding second-hand goods, additional information will also be required on tax invoices issued for second-hand goods that are subsequently supplied. And the reason for this is that where second-hand goods are subsequently supplied, they add VAT on that invoice. It cannot be zero rated, right? And that VAT is actually that it has to be paid actually equal to the notional input VAT originally claimed by the vendor. So that tax invoice needs to include the purchase price paid by the vendor, as well as the notional input tax previously claimed. So SARS wants that to be explicitly stated on the invoice. And I think it makes sense because it makes it easier for them to enforce whether, the right amount of input and output is being accounted for. Then with regard to custom-controlled custom-controlled areas as well as special economic zones. So there is a zero rating provision for services provided to entities that operate in these various zones. The amendment that's going to come through is that the services must be physically rendered in that area to qualify for zero rating. So you cannot provide the service from outside the customs control area or the SEZ and still apply to zero rating. So a big change to suppliers that supply services to these kinds of entities. Next slide. Then with regard to the zero rating of gold, there is a zero rating provision in section 11(1)(f), and it applies to supplies made to a very small group of vendors, like the Reserve Bank, the SA Coin Company or Mint Company, as well as certain banks. So basically, the amendment is to remove the zero rating. And I think what SARS was finding, it was quite difficult to police this. Because you could have a vendor that was supplying gold to various people, including these vendors that are subject to the zero rating, and being able to prove that the goods were actually delivered to the vendor that you could zero rate the transaction to, I think must have been proving quite difficult. But as I said, proved quite difficult. So I think from an enforcement point of view, it makes sense for them to remove the zero rating. Obviously, for the recipient of the supply, having to pay the VAT, that's a cash flow implication, and then having to claim it back through the VAT system. So practical implication, but easier for SARS to enforce. Then with regard to leasehold improvements, currently there's an adjustment provision in section 18C of the VAT Act that applies where the lessor is a vendor. And I think what SARS has realized here is that where leasehold improvements are supplied, it's supplied regardless of whether the lessor is a vendor or not. The lessor actually does benefit from the leasehold improvements. So the provision, the amendment that's being provided for now is to ensure that that adjustment applies regardless of whether the lessor is a vendor or not. Then I think we've covered previously the e-filer distinction, so I won't go through that in detail. Then regarding small businesses, so those that are subject to turnover tax, the annual turnover limit has increased to 2.3 million. So it's aligned with the VAT registration compulsory threshold as well. The turnover tax rates have been adjusted in line, with the adjustments to other tax rates as well. I'm not going to go through that in a lot more detail. And then just to be aware that currently there's a restriction on the year end of an entity that is subject to turnover tax. That restriction will now be removed to make this regime more attractive for smaller businesses. So rather than going through income tax VAT compliance, rather turn to turnover tax is easier to enforce or easier to implement for the taxpayer as well. These changes are effective on the 1st of March. And then with regard to excise duties, Julia, I'm going to hand over to you.
Thanks, Yasmeen. So for the first time in a long time, probably about 6 or 7 years, we have some positive news to report on the sin tax front. Excise duties on alcohol have been increased by the inflationary amount. So we've had several years of significantly above inflation increases, some of that to deal with the effects of COVID, some of that just purely, at least in industry's view, largely a policy mismatch. So for the first time this year, we've got inflationary linked increases on alcohol and tobacco products. Another very positive amendment that stakeholders have been lobbying for many, many years now is the changing of the timing of excise duty adjustment. So traditionally, the increase in rates would be implemented effective immediately from budget day, which makes it quite difficult for producers who are mid-production cycle of a product to apply the correct duty rate. And it resulted in a lot of effective overcharging to ensure that there wasn't an undercharge. What is going to happen from next year onward is that the adjustments will be made effective from the 1st of April, as opposed to from budget day, which is going to provide some very welcome relief and stability and predictability to manufacturing operations. Slightly less good news, we are still finalizing the revised alcohol industry policy. So the national policy on the taxation of alcoholic beverages still up for debate at this point in time, but Treasury have assured us that stakeholder review and engagement will continue and that this will be finalized as quickly as possible. Then on the fuel levy, again, some increases, probably not as bad as it could be, but not as little as what we would want. So your general fuel RAF levies have gone up. Carbon tax on fuel also increased, largely in line, as I understand, with policy. And I think, overall impact, the idea behind the stratification of the increases is to try and smooth the impact of the existing volatility affecting petrol prices. But I think, yeah, it's another year-on-year increase that consumers will have to watch out for.
And let me talk about the carbon tax changes. So firstly, there was no announcement to get rid of the carbon tax at all. It seems like government is really committed to having carbon tax as part of our landscape, our tax landscape. There was some newspaper reports, I think, over the last couple of weeks that the Minister of Electricity, that he had proposed that carbon tax be put on hold, which would have been a welcome change for the big emitters, especially since this tax is a tax that has to be passed on to consumers. But obviously, that wasn't taken on board. So a few changes on the carbon tax front. The first is the carbon tax rate has increased to 308 Rand a ton of carbon dioxide equivalent. That's effective from the 1st of January 2026. So it's for the current tax year, 308 Rand a ton. It's not a huge increase given that the target was to price carbon at $30 a ton by 2030. So, it's quite far off from $30 a ton still, but, an increase on the previous year. A welcome change for those taxpayers that are subject to carbon tax simply because of the number or volume of backup diesel generators they do have. The threshold for registering for carbon tax has increased from 25,000 tons to 25,000 tons. I think the previous threshold was 10,000 tons. So the idea is that the guys that are running backup diesel generators, the only reason why they would need to register is simply because of the volume. That's no longer really going to be an issue except for those that are really large users. And these amendments are all effective on the 1st of January 2026. Then with regard to the sugar tax, there was no mention in the budget about the sugar tax. So it appears that no changes will be made to these rates. So hopefully the sugar industry wouldn't be hurt too much more from the health promotion levy in the current year. And handing over to Julia again for the customs side.
So customs amendments also very light this year. A positive, and it's part of SARS's general customs modernization process, which is moving along quite nicely. We're looking at getting a lot more digitalization. We're looking at getting customs voluntary disclosure rulings, similar things, all migrating into this online ecosystem. Ideally, SARS have promised by the end of 2028 that we will have a fully digitalized engagement platform. And part of that is the current announcement, which is that carnets will be made fully electronic. So currently, one has to actually still apply for a carnet on paper and present that document at the border to take advantage of the free import of samples and other goods that fall under the carnet regime. this is going to be digitalized in line with the World Customs Organization's digitalization mandate, which will make it much easier for traders moving in and out of jurisdictions to apply for and obtain a CRANE from SARS. Something that is less welcome is the proposed amendment of Section 7510 of the Customs and Excise Act. Now, this is a provision that for a very long time was subject to very different interpretation by industry and by SARS. What it effectively provides for is a SARS discretion to allow an importer who has brought goods in under rebate of duty, but has failed to fully comply with the administrative compliance requirements for bringing those goods in. SARS, in terms of this section, has a discretion to condone that non-compliance. And there was a question about when SARS is required to use that discretion, particularly whether they can do so retrospectively, which personally is, I think a lot of advisors agree, the only way that the exercise of the discretion makes sense, because you don't make mistakes preemptively. You only realize after the fact that you have filled out a document incorrectly or failed to lodge something. Be that as it may, finally somebody took this matter to court. And in the JTI Manufacturing Supreme Court of Appeal judgment, the court confirmed that Section 7510 does give the Commissioner retrospective ability to consider and condone, where reasonable, administrative non-compliance. And this saves a huge amount of money, because if one has brought in goods that you have budgeted for, that there will be no duties on those goods, and subsequently you get hit with a massive tax bill because your rebate claim or refund claim is disallowed. That can easily run into the hundreds of millions and billions of rands, depending on the volume of imported goods affected. So the court confirmed that SARS had this discretion and that they must exercise this discretion reasonably and in alignment with the precepts of administrative law. Not 6 months later, Treasury has announced that 7510 is going to be amended ostensibly to clarify in what specific circumstances the Commissioner must exercise the discretion. Admittedly, it is correct that modern tax policy does require the exercise of discretions not to be overly broad and unspecific. We want, specific bases on which an authority exercises a discretion so that we can hold them accountable for the exercise of that discretion. But I think if one has regard to what has happened in the diesel rebate space and the fuel export refund space in recent years, we can expect quite a stringent narrowing of the permissiveness which this section is intended to provide for. So it's going to be interesting to see what Treasury and SARS come up with and how it aligns with the intention of the judgment on the way that the court interpreted the legislation. I think this, there's been a sort of welcome relief for traders that potentially is going to get cut quite short, but remains to be seen what actually comes out when we get the legislative amendments in July. And I think that brings us more or less to the end of our presentation. Mike, I'm going to hand back to you for closing.
Thanks, Julia. There's no questions in the Q&A, so I think probably aligned with the budget, straightforward, etc. I just want to thank you for attending. As always, we appreciate it. And also thank you to Francois Fouche and to my colleagues from Bowmans. And if you have any questions, please reach out. We're more than happy to assist you on these matters. Have a blessed day. Thank you. Bye-bye.